Hello, and thank you for joining our webcast. My name is Jeff Brown, and today I'll be walking through how you can supercharge your credit management strategy and maximize relationships with customers using small business banking data. Credit and risk managers have a difficult task. Their companies are in the business of lending money or granting credit, loans to buy goods and services, as well as establish payment terms. And of course, it's not profitable if these companies don't pay them back or pay back continuously late. Small business banking data represents an evolution in the B2B credit space and gets you closer to the source of financial obligation and their associated insights. In this session, we'll be discussing B2B credit ecosystem, what it's looked like for the past number of decades, and what it has just evolved to in the past few months. From there, we'll take a look at the definition of what constitutes small business banking data and the expectations on the type of data that you can access by working with Equifax as your B2B credit bureau. With this insight, we'll then take the opportunity to examine 3 scenarios in this new financial space and discuss the B2B credit situations where small business banking data has the most impact to your everyday activities, essentially outlining how this changes everything. Once we understand these insights, we'll provide exact references on how you can take immediate action and leverage this into your credit decisions today. As an existing Equifax customer, you already know that we're a global leader in consumer, commercial, and workforce information. Our data is trusted, and our insights are rock solid. Now, by including small business banking data within Equifax business credit reports, we're upping our game even further. In order to explain how, we need to take a look at 2 specific elements: credit lifecycle and the traditional B2B credit ecosystem. This image represents multiple phases and elements across credit lifecycle, from beginning stages of acquisition and origination to complex late active stages of portfolio management and debt recovery processes. Each one of these phases contains its own set of business challenges. It can represent an area where you or your organization might need to tighten its belts or take a closer look at what's currently being done today. In the commercial world, with adjudication predominantly being done manually by credit and risk managers, it also adds an element of pressure and bias by having gut feel decisions. A credit file, when used properly, can essentially build a moat around your business and help protect your receivables. Until you understand where your business challenges are, there's only so much that can be done to protect the DSO and your receivables. So why is this important? The traditional B2B ecosystem has been supporting this framework for the past number of decades. And now with small business banking data, all of these areas are now being supercharged to solve issues before they even become issues and to make more informed decisions. To explain how, let's take a look at the traditional B2B credit ecosystem. So let's talk through this ecosystem in a hypothetical way. This is your business. For a point of reference, you could be a construction company. You may have been in operation for a number of years, have 30 to 40 employees, and have really carved out a niche for yourself and those that work in your organization. You have product and services that serve and address a need, and you're poised to grow, while also protecting the business that you worked so hard to establish. And of course, the world isn't perfect. Someone has encroached on your business and is offering perhaps a different set of services with a few minor tweaks and has a different value and pricing model. Regardless, they're your competitors. They could be large in a different geography or smaller and perhaps more agile. When we combine your business with your competition, this is how we define your industry. It's where you operate, it's where you fight for market share, where you're looking to overcome challenges and to rise to the next level. So what makes you unique? Aside from your determined mindset, your years of experience and skill, your education, you differentiate yourself by the goods that you use to get the job done. Some of these goods could be commonly shared or used by you and someone else in your industry, while others are your secret weapon, built on years of experience and personal relationship and a history of trade activity. These are part of you and your industry's supply chain. And any disruption to any of these elements affects the way that you conduct your business, deliver work, and at the end of the day, invoice your end customers. Who else do you depend on in order to deliver your work and product? It's your service providers. These service providers are also part of your supply chain and offer complementary services to yours. And at the end of the day, combined to enhance the end deliverable to your target customers. When combining your service providers and the goods you use and the businesses that you've established, this magical mixture constitutes your unique value proposition, the one you depend on and the one you follow to lead you to the path you've been down. And of course, we can't forget your end customer, because without them, you wouldn't be where you are today. They purchase you, your products, services, and have uniquely selected you within your industry to be their go-to. They understand you, the value you provide, and they rely on you and your established business and your supply chain so they can go on with operating their business, succeed, and flourish. So why is Equifax explaining this story? It's because we've been with you along your entire journey and been helping you along the way. We've worked with your goods and services providers, as well as clients, and have been helping you and those you work with establish credit. Those within your ecosystem have been supplying their account receivable information to Equifax and helping you establish positive credit history so that when you apply for a company credit card, loan, your credit worthiness can actually be attested to. To the same point, we've also been there to protect you, protecting your business and those you work with from potential fraudulent activity, and highlighting and alerting you to businesses that represent a higher risk from a credit perspective and for you to conduct business with. Much like you might know Equifax for your personal credit score, the same principle exists in the B2B credit ecosystem. Equifax Canada has been managing these relationships across hundreds of industries for a number of decades and have been combining this with information such as collections, industry group information, public records, investigations, and bankruptcy information to build up a robust system of commercial risk identities. We've sharpened the reports, the data, the scores over those years, but for the most part, the idea of the B2B credit ecosystem has always been the same. That is until now. So what's different? What's changed? Why does this matter? Small business banking data represents a monumental shift in the B2B ecosystem. Over the past few years, Equifax has collaborated with the financial industry to build out a robust consortium. This consortium spans the traditional big banks, credit card companies, sometimes referred to as monolines, and credit unions. Based on a foundation of trust and value from the consumer side of our business for delivering value and insights for personal credit reports and scores, the same institutions have begun providing Equifax with access to their small business portfolio that they manage. These portfolios include credit cards, lines of credit, overdraft accounts, and fixed installment, things like term loans, mortgages, and leases. So let's pause for a moment and let this concept have an impact on us. This means that everyone has the ability to view direct financial obligations that any small business has with its bank. No longer just relying on its trade history and credit to be established, no guessing on the financial obligations that a small business has with its bank. It's all there, plain as day, available for your consumption and to leverage into your next major credit decision. Wow, that's powerful stuff. So how can this information be viewed? That's the beauty of this evolution. Equifax has been there for you in the past, and with Equifax establishing this consortium, we've already set the path forward for it to be leveraged, exactly how you've grown to use our traditional trade line intelligence and reports. Whether it's logging in online to pull a business credit report or having a direct system-to-system connection, it's there for you, ready to use. We'll walk through the specific elements in a moment's time. Now into some of the data details. As I mentioned, small business banking data from financial institutions represents an evolution. So let's examine the definition of small business banking data. On a monthly basis, the consortium of financial institutions provides their small business book of business throughout their portfolio. And Equifax actually takes this and includes it into our business credit reports. These data feeds include any business that has a product from a commercial credit position of less than $500,000. Included in this is also referential information, such as personal guarantees, utilization amounts, payment terms, severe status indicators, as well as many others. So what does this influx of net new data mean to Equifax business credit reports and you as a customer to view this information? These numbers should speak loudly. 10% increase to the total number of business credit reports available. What this means is that there was an entire footprint of companies that never had any formal trade line activity available. And by having the small business banking data, they now have a presence and visibility to you and your credit decisions, and therefore a business credit report available. Previously, these could have been companies that you established limited trade activity with because they had no established trade activity. When these companies could actually have been your high growth accounts, or could actually have been high risk accounts that caused you write-offs. 18%. This is the blended hit rate percentage across all industries. As I mentioned earlier, there are definitions of what constitutes small business banking data from the financial institutions. So while you'll see it in a number of your reports, it's important to know that it represents a percentage of the overall reports. Over 750,000 small business trade lines updated monthly is an enormous number. These direct channels with financial institutions represent a high volume of updated information and something you can expect to be new and refreshed on a frequent basis. Okay, now that we know what the B2B credit lifecycle is, how small business banking data represents an evolution to the B2B credit ecosystem, and how much data is now readily available, let's take a look at a few scenarios. The first scenario is credit approval, which is the foundation of how a lot of companies typically leverage business credit reports from Equifax. So we'll look back at a slice of the B2B credit ecosystem. In this scenario, a company would like to purchase products and services from your business. Before small business banking data, understanding credit worthiness was based purely on the back and forth arrow on the left-hand side of the screen. What this meant was that a negative occurrence such as a delinquency or collection could only be seen once it actually happened. In essence, it was a high-risk game of Russian roulette between you and your competitors. Was a negative occurrence going to happen to your competition first, or you? And as soon as it does, the industry would react, change credit terms with that company, and set more aggressive collection policies. Essentially, the quicker you react, the more likely you are to get at least a portion of your funds or assets back. Now with small business banking data, it allows us in the same situation to view the financial obligations of that same company in order to determine the likelihood of risk. Before this data was available, it was a guessing game on what company's obligations were to its bank. And now it's completely transparent. Now, instead of using your accounts receivable policy as a leverage to pay off their bills, you can view that company's utilization levels on loans and credit cards to prevent write-offs or risk from even happening. So, as key insights, you can leverage the small business banking data as an early warning detection system for credit approval process. In addition, you can use this new data stream as a way to gain insights and perspective on clients or customers with no traditional trade history on file. Powerful, powerful stuff. On to our next scenario. This scenario takes into account the supply chain aspects of your business and how they could be supercharged and protected by small business banking data. It's no secret that the goods and services that you consume as a business owner are the lifeblood of your company. The second that one of those elements isn't available or faces delay in being available, it dramatically affects your cash flow and your ability to bill and invoice your customers. Before small business banking data, that analogy of Russian roulette with clients also holds true with the goods and services aspects of your business. Visibility into your supply chain and your associated financial ties was limited by the first negative occurrence that actually happened, which could have been to either you or your competition. Now with the small business banking data, an advanced or early view of your supply chain can be seen. What this means is that if you have a key supplier, which is fundamental to your day-to-day operations, you can actively monitor their financial ties to their bank. The moment that these utilizations reach high levels or negative or severe status between them and their bank happens, you can take action by limiting your next order or services with them, such as purchasing less units, or simply use it as a call to action to investigate alternative suppliers. So, as key insights, small business banking data is critical to maintaining the daily operations of your business and the dependencies that you have within your supply chain. As part of this, and it goes without saying, disruptions to your supply chain result in negative customer satisfaction, causing cash flow challenges. On to our last scenario. Aside from just identifying risk, credit information can be used to identify companies that are poised for growth. essentially your ideal target customers. In order to grow as a business, it's imperative that you align yourself with customers and clients that are aligned to market trends and are poised for potentially explosive growth. In the previous B2B credit ecosystem, clients who experience growth could be identified as companies who are establishing more and more trade lines with higher and higher trade line values. Much like the negative occurrence analogy with Russian roulette, these types of companies couldn't be identified previously until that growth had actually already been established. With financial information now available for your review, it's now completely transparent when a small business applies for a large loan, which they may be doing to hire new employees, franchise a location, or invest in new equipment or processes that will set them up for net new increased revenue streams. By seeing these obligations being created as they happen, you can align your business and operations to these companies to ensure that you're invested in their success and align yourself to their goals in your competitive industry. This is the type of intelligence that will set you ahead of the rest. So as far as key insights are concerned, it's important to remember that you can gain timely and relevant insight into your customers by monitoring your portfolio for both financial and non-financial information. If done correctly, you'll be able to profile your best customers and expand your business footprint. So now that we know which use scenarios this data can be leveraged with, you might be asking yourself, where do I start? The answer might be quite simple. You might already have access to this information. You may have noticed over the past few months that we've made some modifications to the layout and content of the business credit report. This has been done across 4 essential areas. The report highlights an alert section, principal or guarantor associated business, financial trade details, and specific guarantor information. If you don't see this information or sections within your business credit report, don't worry. Contact your account executive. Converting could potentially be free of charge. If you use the business credit report, you're used to seeing this view. However, the new data elements that have been added to the financial are added there in the financial column, which itemizes the financial trade lines as well as utilization summary at the bottom of the section. The utilization rate should be viewed as a health check indicator for that given company. If it's high, the risk on your trade obligations could actually be increased dramatically or could be affected dramatically. When the data is available, a new section will also be in the business credit report. This lists the principal and or guarantor of that business. The section also has the ability to list business associations, which can be helpful for fraud and loss detection. And last but not least, the financial trade detail section. This section is similar to the table that you're used to seeing with traditional trade lines. However, it provides a detailed view on the financial obligations instead. It provides indications on account types, credit limits, payment types, as well as many other details. This provides the detailed assessment on how leveraged a company might be based on its revolving and fixed financial trade lines. If you receive business credit reports via a system-to-system connection with Equifax, there's also 28 new attributes that are available for your usage in risk modeling and scorecarding efforts. Much like I stated previously, you might already have access to this information. If you don't see it, please reach out to your account executive. 4 attributes highlighted here have a different impact to financial institutions and non-financial institutions. For financial institutions, these already bad account indicators provide a view into the negative occurrences and amounts faced by your competition. For non-financial institutions, it provides an indication of the financial negative occurrences, which aren't included in traditional trade line scoring. It essentially represents an alert. The 2 attributes highlighted here, severe status and severe status date, also work as an alert, as it provides a negative history indicator for a company's financial obligations to one or more of its banks. If you're a financial institution, this information provides an opportunity to perform a risk assessment and performance benchmarking. The small business banking data now available for enough of a period of time to accurately monitor and have an observation period, we can definitively say that percent utilization for revolving credit is the single strongest small business banking attribute that can provide predictiveness for negative occurrence. a negative occurrence being delinquencies, collections, legal actions, and bankruptcies. Again, if you have any existing scorecarding efforts with Equifax, it's critical that you bring this into that in how you actually calculate. Not to be outdone, total outstanding amount and total current balance are also strong predictive indicators for negative occurrence. When used in combination, they are powerful additions to any scorecarding efforts. 90-day credit limit, while not being as predictive as some of the other attributes available, still provides an element of a health check or alert, which can provide you with an indication of whether or not a company is recovering from a recent negative occurrence or a large financial obligation. Total scheduled payment amount is a great way to be able to get an in-depth look in the month-to-month financial terms that a company must meet. Depending on the account type, revolving or fixed, different decisioning and scorecarding models can actually be put in place. Okay, we've covered a lot of information in a short period of time, so let's talk about taking action. If there's any question or issues that you're currently facing, or even need guidance on how to build strategy around the various stages of the commercial credit lifecycle, whether it be acquisition, risk modeling and scorecarding, adjudication, fraud management, portfolio management, and debt recovery, you have access to Equifax consultants who are well-versed in the B2B credit space and can help you unlock the data-driven insights you're looking for. So we've outlined the evolution that small business banking data means to the B2B credit ecosystem, the amount of data that flows through this net new ecosystem, the scenarios and how the data changes your previous interactions with B2B credit, as well as how to leverage this data today. This takes us to the bottom line. Small business banking data provides supercharged improvements across all areas of the credit lifecycle and represents an evolution in the B2B credit ecosystem. Thank you for choosing Equifax as your trusted credit bureau. If you have any questions, we're always here to help. Thanks again.